What's up, everybody? Welcome to the 24th episode of the Investing Penguin. Covered calls and cash secured puts. A quick shout out to our newest subscribers: Shooter, Eves, Hammertoad1, Paul Snellings, Mosh R, Baroness Nina, Salocabrit, Thrasher Charged, Brian Collins. Wow, so many new subscribers. Did I miss anyone? Let me know in the comments below. Thank you for subscribing to the channel. And for everyone else, hit that subscribe button. Well, this video is finally here. So many of my loyal subscribers have been asking great questions, and in this video, I break down the trade process from beginning to end for writing covered calls and cash secured puts. And stick around till the end as I share some interesting facts about inflation. Wow, there's a word we hear in the news every day. And please subscribe to the channel. It's supposed to help all my YouTube algorithms and make me filthy rich. Nah, seriously, if you appreciate these videos, then please subscribe and share with your investment friends. For those of you who don't know me, I am the Penguin. And in this video, I break down the trade process for writing covered calls and cash secured puts. Just like anything else in life, you have to work hard. Nobody is just going to hand over the keys to the Bentley. For me personally, these action items are vital to my trade process for writing covered calls and cash secured puts. We're going to review all these in greater detail in this video. So let's jump into this. Time's a-wasting. So crank up the AC and put a 6-pack of beer on ice. This video is going to be blistering hot. Step number 1. You are here to make money. If you are watching this video right now, then you are interested in making money through stock options, using covered calls and cash secured puts. Step number 2, establish your investment objective. I say your investment objective because everyone's situation is different and everyone's investment objective is different. You need to put pen to paper and write down and define your investment objective. You have to ask yourself some really tough questions and think about them. Are you investing for the next 5 years, 10 years, 30 years? Are you investing for your kids' college education, a vacation to Hawaii, or your retirement? How much risk are you willing to accept? How much do you want to make? Doubling your money in 6 months is a recipe for disaster. Do you have a job? Do you have a family? Do you have debt? Do you like to drink whiskey and gamble? For me personally, I want to make 24 to 36% annualized returns. If I can do that, then I should be able to double my money every 3 to 4 years. I want to invest in stocks that pay dividends because if I get stuck with these stocks during a down market, at least I can still collect the dividends. I have to be willing to own these stocks long term. I want to maintain a conservative stock portfolio. You know, I worked too hard in my life to see all my money disappear in a risky meme stock. I need to go to bed at night with a clear mind. Finally, I want to maximize my downside risk. And the premium collected from covered calls and cash secured puts is a great way to accomplish this. Step number 3, how to pick your stocks. We're not going to review this in detail since we already covered this in episode number 15, so please watch that video. Right now it's my most popular video, so definitely check it out. Once again, this is highlighted in episode number 15. But here's the list of all 34 stocks that I have performed covered calls and cash secured puts with. These stocks align with my investment objective. You need to develop your list of stocks that align with your investment objective. Step number 4. Lots of people ask, what should I start with, the covered call or the cash secured put? Well, it depends. Isn't that the number one answer in life? It depends. What should I do? Well, that depends on you. So just to recap, with covered calls, you're buying stocks at the market price and generating premium, aka cash flow. Depending on the ex-dividend date, you can also capture dividends. There is limited upside with covered calls, but downside protection. So when a stock is trending upwards, sideways to higher, that is a great time for selling covered calls. For me, I love selling covered calls and capturing dividends on conservative stocks that are trending upwards. I recommend watching episode number 21 on Bristol Myers Squibb, where I executed 4 covered calls and collected 1 dividend payment over a 90-day period. Or watch episode number 16 on Chevron, where I executed 11 covered calls and collected 2 dividend payments over a 209-day period. With cash secured puts, you are buying stocks at a discount and generating premium, aka cash flow. There is zero upside with cash secured puts and all downside protection. When the market is getting hammered, that is a great time to sell cash secured puts. When there is downward pressure on a stock, that is a great time to sell cash secured puts. For example, last week Thursday, January 13th, JPM closed at 168.12 a share. JPM announced earnings at night, and then Friday, January 14th, JPM got pummeled and closed at 157.89 a share. I sold cash secured puts that day for the 155 strike price and collected premium. I recommend watching episode number 19, where I highlight 7 cash secure put trades when the market got hammered during the Omicron news. Well, if you are unsure about starting with the covered call or the cash secured put, well then you are in luck because you can do both. You can use the wheel strategy. Sell cash secured puts just below the stock's trading price, collect maximum premium and get assigned the shares, and then start selling covered calls ASAP. If you are not assigned the shares, just rinse and repeat until you get the shares assigned. Step number 5, pick your strike price. Lots of people ask, what strike price should I choose when selling covered calls and cash secured puts? Well, that depends. Depends on your investment objective. With covered calls, I see 3 scenarios or 3 strategies. Number 1, pick a strike price just out of the money above your cost basis to collect maximum premium. You get good downside protection but limited upside. Number 2, pick a strike price deep out of the money but still generates a 24 to 36% annualized return. That return is my investment objective. You need to insert your own. You collect a smaller premium, you get limited downside protection, but you maximize your upside. Number 3, pick a strike price deep in the money below your cost basis, but still generates a 24 to 36% return. Once again, that return is my investment objective. Insert your own. You collect a large premium with lots of intrinsic value. You get huge downside protection but zero upside. This is a very conservative covered call strategy, and there are investors who use this strategy exclusively. Facebook actually has a group that you can follow called the Conservative Covered Calls. With cash secured puts, I also see 3 scenarios or 3 strategies. Number 1, pick a strike price just out of the money, just below the trading price to collect maximum premium and get good downside protection. This will result in a good discount if you get assigned the shares. Number 2, pick a strike price deep out of the money, well below the trading price, but still generates a 24 to 36% annualized return, which is my investment objective. You insert your own. You collect a smaller premium, but get huge maximum downside protection. This will result in a huge discount if you get assigned the shares. Number 3, pick a strike price in the money. I've only seen this scenario a couple of times on other channels. For me, I have never picked a strike price in the money for cash secured puts. This implies that the stock is moving upward and you are willing to overpay or buy the stock at a premium. So I would just perform covered calls instead. If anyone listening has more insight on this strategy, throw it in the comments below. I would love to understand it more. This is a snapshot of the option schedule for calls and puts, highlighting in the money and out of the money. I'm going to be honest, it gets confusing, so it's really important you understand and review all your trades before executing the trade. Step number 6, pick your expiration date. So lots of people ask, what expiration date should I choose when selling covered calls and cash secured puts? Well, that depends. Depends on your investment objective. Do you see a trend here with my answers? For me, 2 to 3 weeks is my sweet spot. I don't want to have my money tied up beyond 3 weeks. A lot can change in 30 days, but some investors like locking in that higher premium with a 30-day strike. Many covered call experts say to avoid an expiration date that goes past the earnings announcement. The news nowadays is a huge driver in stock prices. Like I mentioned earlier, JPM stock took a big hit last week Friday, the day after earnings. If you're using the dividend capture strategy, then make sure you know the stock's ex-dividend date. Finally, you can really benefit using covered calls and cash secured puts in your Roth IRA account or your traditional IRA account. Time is on your side, so you can use longer expiration dates to collect more premium. Watch episode number 20, Covered Calls and Cash Secured Puts in your retirement account. Hopefully you have seen this chart before on time decay. Time decay is the arch enemy of all option traders. Here's the earnings schedule for January. This is the definition for the ex-dividend date according to the U.S. Securities and Exchange Commission website. This is a recap slide from episode number 20, so make sure you watch that video. Step number 7. So lots of people ask, hey, I'm looking for the best stocks under $5 so I can buy a lot of shares. Can anyone recommend? Or, hey, I only have $10,000 to invest. Can anyone recommend stocks that are ready to take off? Well, it doesn't make a difference how many shares you buy or the price of the stock. It's the return on your money. The only limitation with options is that you need a minimum of 100 shares. And it doesn't make a difference if you have $5,000 or $500,000 to invest. It's the return on your money. If beginner investors are looking to double their money in the first year with risky stocks, that's a recipe for disaster. Step number 8. Calculate annualized returns. So understanding annualized returns is very important. If you are struggling with calculating the tip on your restaurant bill, you really need to go back and review your math, especially percentages. You need to crunch the numbers before you complete a trade so you know if it makes sense. For me personally, my objective is to make 24 to 36% on each trade. That's 24 to 36% on an annualized basis. So option trades can vary depending on the expiration dates, the strike prices, the premium. It's important to know your potential return on an annualized basis. This is a brief overview, but the annualized return is as follows. Your profit divided by your stock investment equals your return. So if you make a $1,000 profit on a $50,000 stock investment, then your return is 0.02 or 2%. Then you take your return, divide it by the number of days for the trade, and that gives you the return for 1 day only. So a 2% return on a 20-day trade is a 0.1% return for 1 day. Then you take your return for 1 day, multiply it by 365 days, and that gives you the annualized return. So a 0.1% return for 1 day multiplied by 365 days gives you a 36.5% annualized return. And that is a great return. So here's the snapshot of my spreadsheet analysis for covered calls and cash secured puts, which calculates the annualized return. This is an example of a Walgreens trade. If you're watching this video on your cell phone, it's going to be difficult to see the numbers, so I recommend switching to a larger screen. And I also highly recommend developing your own spreadsheet or downloading one from another investment channel. Like I've said before, I'm not here to sell you anything, so I have no problem sharing the information from other investment channels. Here are all the details of that Walgreens trade, and we are going to break down the numbers to see how we calculated the 41.95% annualized return. So you're going to need to know the current trading price of the stock, you're going to need to know the purchase price of the stock, and the strike price of the covered call. In this example, the stock was bought at $48.41 a share and immediately wrote a covered call. The strike price is $49 a share. You are going to need to know the purchase date of the stock, the trade date for selling the covered call, and the expiration date of the covered call. In this example, the stock was bought on August 10th of 2021. The trade date for the covered call is August 10th of 2021, and the expiration date is August 27th of 2021, which means if the shares get assigned, the stock will be sold the following Monday on August 30th of 2021. You are also going to need to know the premium price per share for selling the covered call, the commission cost of the trade, and how much premium is collected. In this example, the covered call was sold for 53 cents per share. The commission paid on the trade is $6.63, and the premium collected is $523.37. The premium of $523.37 divided by the investment, which is the $48,410 paid to buy the stock, calculates to a return of 1.0811% for 20 days. So this part of the spreadsheet is helpful because it automatically calculates the break-even point. Paid $48.41 per share for the stock, received 53 cents per share in premium, so the break-even is $47.88. That's the downside protection. And this part of the spreadsheet is helpful because it automatically calculates the upside in stock gain. The strike price is $49 per share, paid $48.41 per share for the stock, so the upside is 59 cents per share. The stock proceeds are $49,000, the commission is 50 cents, the stock purchase is $48,410, so the stock gain is $589.50. The stock gain of $589.50 divided by the investment, which is the $48,410 paid to buy the stock, calculates to a return of 1.2177% for 20 days. Finally, the premium collected of $523.37 and the stock gain of $589.50 is a total profit of $1,112.87. The total profit divided by the investment, which is the $48,410 paid to buy the stock, calculates to a return of 2.2988% for 20 days. On a monthly basis, the return is 3.4483%, and on an annualized basis, the return is 41.9539%. Step number 9, execute the trade. So lots of people ask, can you record a live trade so we can see what it looks like? And unfortunately, I don't have the setup to do live streaming and recording at this moment. So here's a snapshot of what it looks like to execute the trade for selling a covered call. Bank of America is trading at $48.64, so I chose an out-of-the-money strike price at $49, slightly above the trading price. I like to use the limit order function, so the bid is $1.16 and the ask is $1.20, so I want to get anything above $1.20 to maximize my premium collected. I start with $1.25 and I work my way down until the trade is executed. So here's a snapshot of what it looks like to execute the trade for selling a cash secured put. Bank of America is trading at $48.59, so I chose an out-of-the-money strike price at $48.50, slightly below the trading price. Once again, I like to use the limit order function, so the bid is $123 and the ask is $131, so I want to get anything above $1.31 to maximize my premium collected. I start with $1.35 and work my way down until the trade is executed. Step number 10, manage the trade. So after the covered call or cash secured put trade is started, lots of people ask, my stock is tanking, what should I do next? Or my stock is running up, I don't want to lose the shares, what should I do next? I highly recommend paper trading first. Managing your trades just comes with experience. Consider it on-the-job training. You just need to do it because every situation is a little different. I really don't like to buy back shares because that costs me money. In 2021, I only bought back 11 trades. I truly believe this makes sense. When you invest in good, conservative dividend paying stocks, the trades are much easier to manage because there is less volatility. Of course, you will receive less premium, but that is the trade off. And finally, you have to make quick decisions. You have to be able to adjust to fluid situations. You have to be proactive. You cannot procrastinate. So here's a breakdown of those 11 trades I bought back in 2021. In February of 2021, oil and PSX just kept going higher and higher, so I bought back my shares and rolled up and out to the 85 strike price and a further out expiration. Also in October of 2021, oil and PSX was due for a pullback, so I bought my shares back, sold my PSX stock, and locked in profits. In December of 2021, JPM was pulling back, so I bought back my shares and I rolled down and out to the 160 strike price and further out expiration. I thought this is a really good snapshot on the Fidelity website that explains the different rolling techniques for managing your covered calls. Step number 11, close the trade. So if you decide to close the trade prior to the expiration date, make sure you buy to close the exact same transaction. Like I said before, I really don't like to buy back my trades because that costs me money. And one of the nice things about selling covered calls and cash secured puts is if the trade goes to expiration date and expires worthless, no action is needed. There's less to manage. So here's a snapshot of what it looks like to buy back the trade for a covered call. You have to make sure the strike price and expiration date match your original trade, and you want to pay less than the bid ask. Here's a snapshot of what it looks like to buy back the trade for a cash secured put. Once again, you have to make sure the strike price and expiration date match your original trade, and you want to pay less for the bid ask. Step number 12, review the final numbers. This step is pretty much self-explanatory, and we learn best when we learn from our mistakes, especially our mistakes that cost us money. Well, that's it. Time flies when you're having fun. Having fun making money, that is. More videos are coming, and stick around for 10 seconds more as I share some interesting facts about this word from 40 years ago, this word called inflation. Inflation is a decrease in the purchasing power of your money, reflected in the general increase in the prices of goods and services. Inflation affects all aspects of the economy, from consumer spending, business investment, employment rates, to government programs, tax policies, and interest rates. Understanding inflation is crucial to investing because inflation can reduce the value of your investment returns. Inflation had averaged 3.2% annually since World War II, and then more than doubled after the 1973 oil embargo to 7.7%. By 1979, inflation reached a high of 11.3%, and by 1980, inflation soared to 13.5%. High inflation and a terrible economy didn't help Carter's re-election campaign in 1980, and after Reagan took office in 1981, inflation was finally under control again. All of our recent presidents have done a very good job with inflation except Biden. Inflation is now 7%. But in reality, the cost of everything is increasing faster than our wages. Most Americans get maybe a 3 to 4% raise each year, while our medical costs, tuition costs, housing costs, energy costs are rising at a much higher rate. I'm supposed to get a raise next week, you know damn well I won't. Working for a living, working for a living. Money music. Huey Lewis and the News. Working for a living. Huey Lewis and the News is an American rock band out of San Francisco. They had a run of hit singles during the 1980s and early 1990s, achieving 19 top 10 singles across the various billboards. Their most successful album, Sports, was released in 1983. Disclaimer: I am not a financial advisor. This video is for entertainment and educational purposes only. I'm only sharing my experiences and opinions. Investing involves risk, so please seek advice and educate yourself.